If you're thinking about buying a house right now, pause for a second, because what I'm about to say isn't about interest rates or whether prices will crash or what some economist on TV thinks is going to happen next year. It's about what buying a house will quietly do to your life and your financial structure. And most people don't think about that part until it's too late. Because when you picture buying a house, you picture stability. You picture keys in your hand. You picture your own space. You picture finally feeling like you've made it. But here's the uncomfortable truth. For a lot of people, buying a house doesn't create security. It rearranges their entire risk profile in ways they don't fully understand. And I don't say that to scare you. I say it because this is one of the biggest financial decisions you'll ever make in America. And it deserves more than a surface-level pros and cons list. And the reason it deserves more is because a house is rarely just a financial asset. It becomes the backdrop of your daily life, your routines, your stress levels, your sense of control. And when something carries that much emotional weight, it deserves a deeper lens than rent versus buy calculators. You probably feel some version of pressure right now. Maybe your rent went up again. Maybe your friends are buying. Maybe your parents keep asking when you're going to stop throwing money away. Maybe you're just tired of feeling temporary and owning feels like permanence. But before you sign a 30-year mortgage, I want you to think about something deeper than the monthly payment. I want you to think about margin. Margin is the quiet space in your life where things don't break you. It's the gap between what you earn and what you're obligated to pay. It's the reason some people sleep through economic downturns and others lie awake at 2 a.m. Staring at the ceiling and buying a house changes your margin immediately. It also changes your monthly psychology, because when your largest expense becomes immovable, every other decision starts orbiting around it. On paper, it looks simple. You swap rent for a mortgage, but in reality, you're swapping flexibility for fixed structure because a mortgage isn't just principal and interest. It's property taxes that rise over time. It's insurance premiums that fluctuate, especially in certain states. It's maintenance that you can't predict. It's a roof that one day needs replacing. It's a furnace that fails in winter. It's a water heater that bursts at the worst possible time. And those aren't theoretical risks, they're inevitable events. And unlike market volatility, which tends to recover over time, home repairs arrive on their own schedule and demand immediate cash. When you rent, your landlord absorbs those shocks. When you own, you do. And that shift alone changes how your nervous system experiences money. Now let's talk about liquidity, because this is where things get subtle. Like when you buy a house in America right now, especially in a market with 6 to 7% mortgage rates, you're likely putting down tens of thousands of dollars, sometimes more, and that money doesn't disappear. Technically, it becomes equity. But equity is a liquid. It's trapped inside the walls of a property, and to access it, you either sell or borrow against it, and both come with friction and cost. So while your net worth might look healthier on a spreadsheet, your access to capital shrinks, and access to capital is what creates optionality. Optionality is the ability to say yes or no without panic. It's the ability to take a career risk, move cities, start a business, or even just endure a layoff without immediately spiraling. And when you drain your savings for a down payment and close with minimal reserves left, you haven't increased your security, you've compressed your flexibility. And compressed flexibility often shows up months later, not immediately, in small hesitations and delayed decisions that slowly narrow your path. Most people don't frame it that way. They frame it as building equity instead of throwing money away on rent. But that phrase ignores opportunity cost, because the money you put into a down payment could also be invested in low-cost broad market index funds and ETFs, historically returning roughly 7 to 10% annually over the long term before inflation adjustments. And when that capital compounds uninterrupted for decades, it builds something powerful, not flashy, not viral, but steady. And steady is what builds real wealth. And steady has another advantage. It removes the need to be right about timing, because diversification across thousands of companies reduces the consequence of any single mistake. I'm not saying renting is always better. I'm saying buying is not automatically better, and the difference depends on structure. If your income is stable, your emergency fund remains intact after the down payment. Your monthly housing cost leaves meaningful room to continue investing, and you plan to stay in the home for 7 to 10 years or more. Buying can absolutely make sense because over long horizons, you reduce the friction of moving. You potentially benefit from appreciation, and you lock in a housing payment that becomes more manageable as your income grows. But that's a specific profile, and many people stretch beyond it because the social narrative says home ownership equals success. There's something deeply psychological about owning property in America. It's embedded in the culture. The idea of the American dream is tied to a house with your name on it, and that symbolism carries weight, but symbolism doesn't pay property taxes, and it doesn't repair foundations, and it doesn't protect you if you're house poor. House poor is a phrase that sounds dramatic until you see it in real life. Someone earns a solid salary, qualifies for a large mortgage, buys a beautiful home, and then realizes their discretionary cash flow has evaporated. Investments slow to a crawl, vacations disappear, stress increases, and every unexpected expense feels like a threat instead of a nuisance. And this is where buying a house stops being a financial decision and becomes a psychological one. When your fixed costs rise significantly, your tolerance for risk falls. You become more conservative in your career. You hesitate to make changes. You cling to stability because your obligations demand it, and sometimes that's fine. But sometimes it quietly reshapes your trajectory. It can reshape who you become professionally, because financial pressure narrows creativity, and narrowed creativity limits upside. There's another layer most people miss, and that's the time horizon mismatch. If you buy with the expectation that you might move in 3 to 5 years, transaction costs alone can erode gains. Real estate agent fees, closing costs, moving expenses, they add up quickly. And short holding periods amplify market risk, because housing doesn't move in straight lines. Not smoothly, not predictably, year to year, and if your purchase is leveraged at today's rates, even small price stagnation can flatten your return after costs. Compare that to renting and investing the difference in a diversified portfolio of low-cost ETFs, tracking the broad market. And suddenly the math isn't obvious anymore, especially if you maintain higher investment contributions during those early high-growth compounding years. Those early years matter more than most people realize because the dollars invested in your 20s and 30s often compound for the longest stretch. And interrupting that compounding window can have long-term consequences that don't show up immediately. This isn't anti-house, it's anti-autopilot. The decision to buy should be grounded in your life plan, not just market conditions or peer pressure. Ask yourself, if I lost my job 6 months after closing, would I feel stable or trapped? If interest rates dropped next year, would I feel regret or indifference? If housing prices dipped 10%, would I panic or continue living my life? Your answers tell you more about readiness than any mortgage calculator. And here's something else to consider. Owning a home doesn't eliminate housing risk. It concentrates it. When you buy, you're heavily exposed to one asset in one geographic area. And while diversification across stocks through broad market ETFs spreads risk across thousands of companies globally, homeownership places a significant portion of your net worth into a single property in a single city tied to local economic conditions, zoning changes, and demographic shifts, and concentration increases volatility of outcome, even if it doesn't feel volatile day to day. But let's flip it, because I don't want this to sound one-sided. For some people, buying a house reduces anxiety significantly. It creates emotional grounding. It allows customization. It eliminates landlord uncertainty. And if that emotional stability increases your overall life satisfaction and productivity, that matters too. Money decisions aren't purely spreadsheets, they're lived experiences. And if ownership aligns with your identity and long-term plans, and you've built a solid financial base first, it can be empowering. The key phrase there is built a solid financial base first. Because when your emergency fund is strong, your investments are already compounding in diversified low-cost funds, your debt is manageable, and your monthly margin remains intact after the mortgage. Buying becomes a strategic extension of stability rather than a leap of faith. The mistake people make is buying to feel secure before they've actually built security. Security comes from liquidity, diversification, and consistent investing habits, not from a deed alone. A house can be part of a wealth plan, but it's not the foundation of one, and when you reverse that order, you increase fragility. Think about it this way. If your financial life were a structure, investments in broad market ETFs are like the reinforced concrete foundation, diversified, low cost, designed to weather decades of economic cycles, and a house is like a large addition built on top, beautiful, functional, but heavy. And if the foundation isn't strong, that weight amplifies stress cracks. And stress cracks don't show up immediately, they form quietly under pressure, only becoming visible when the environment shifts. That's why the question isn't, is now a good time to buy? The question is, does buying strengthen or weaken my financial structure? If it strengthens it, because your margin remains healthy, your liquidity remains intact, and your long-term investing continues uninterrupted, then it might be a powerful move. But if it weakens it, compresses your cash flow, drains your reserves, and halts your investment contributions, then you're trading flexibility for optics. And optics don't compound. Over time, what builds wealth in America isn't the emotional high of closing day. It's the boring repetition of investing consistently, keeping costs low, allowing 7 to 10% long-term market returns to layer upon themselves year after year, and protecting margins so downturns don't force bad decisions. Buying a house doesn't automatically derail that process, but it can if done prematurely or aggressively. So before you sign anything, step back and evaluate your structure, not your feelings, not your neighbor's timelines, not headlines about rates, but your own balance sheet and psychology. Do you have at least 6 months of expenses after the down payment? Will you still invest monthly into diversified index funds? Does your mortgage payment leave breathing room? Are you planning to stay long enough to justify transaction costs? Does ownership align with your career flexibility? These are the questions that matter. And here's the quiet truth most people won't say out loud. Buying a house is not the final step of financial maturity. It's a trade-off decision between stability and flexibility, and the right answer depends on what you value most at this stage of your life. If you crave permanence and are structurally prepared, it can feel grounding, but if you crave optionality and are still building your base, renting while aggressively investing can sometimes be the more powerful long-term move. Neither choice is morally superior, only structurally different. So if you're thinking about buying a house, watch this first. Not to be convinced one way or the other, but to make sure you're choosing from strength instead of pressure. Because once you commit, you're not just buying walls and a roof, you're buying a long-term financial posture, and posture determines how you experience every economic cycle that follows. Choose the posture that increases your margin, protects your compounding, and supports the life you actually want, not just the one that looks good from the outside, and that's when the decision becomes powerful instead of reactive. And that's when you move from reacting to headlines to building a life on your own terms. And that shift, more than the house itself, is what truly creates long-term security. And here's the part that almost nobody says out loud. The house won't fix your relationship with money. It will amplify it. If you already feel anxious about finances, a larger fixed payment will likely increase that anxiety. If you already feel disciplined and structured, ownership can feel like a natural extension of that discipline. The property itself doesn't create the mindset. It reveals it. And that's why this decision deserves self-awareness as much as financial preparation. Think about who you want to become over the next decade, not just where you want to live. Do you want mobility, experimentation, and the ability to pivot quickly? Or do you want rootedness, stability, and deeper ties to one community? Neither path is superior, but each carries trade-offs that compound over time just like investments do. The most powerful financial moves are rarely the loudest ones. They're the ones that quietly align your structure with your values. And when those two line up, stress decreases, decisions become clearer, and long-term wealth has space to grow without constant friction. Buying a house can be part of that alignment, but only if it's chosen from clarity, not urgency. And clarity comes from understanding your margin, protecting your liquidity, respecting opportunity cost, and remembering that real security is built layer by layer, not signed in a single afternoon at a closing table. If you can make this decision calmly, with reserves intact, investments still compounding, and room in your budget for life to happen, then you're not buying out of pressure, you're buying from strength, and strength, not timing, is what ultimately determines whether this becomes a stepping stone or a strain on everything you're trying to build. So here's what I want you to walk away with. Buying a house is not a race, it's not a badge, and it's not a guaranteed upgrade to your financial life. It's a structural decision that will shape your margin, your flexibility, and your stress levels for years to come. And the goal isn't to time the market perfectly or to follow what everyone else is doing. It's to make sure that when you do buy, you're doing it from a position of strength, with liquidity intact, investment still compounding, and enough breathing room to handle life without panic. If this helped you think more clearly about the decision, that's exactly the point of this channel. We break down financial milestones not with hype, but with structure and psychology, so you can build wealth calmly and deliberately. If that's the kind of approach you value, subscribe, because we're going to keep unpacking the decisions that quietly determine your long-term freedom. And I'd rather you move slowly and confidently than quickly and reactively. And that's how real wealth is built.